Good evening, ladies and gentlemen, and welcome to our class on retracements and reversals sponsored by Alvexo, one of the world's leading providers of forex and CFD trading. Now, Alvexo is a regulated provider, and if you can't access their site, it means they're not regulated in your home country. But if you like during this class, if you go to www.alvexo.com and open a demo account, you just need a username and a password and start using it. You can follow along using their charts to understand retracements and reversals. Now, Alvexa's new web trader gives you the simplicity of trading. It's user-friendly. It's got tailor-made reporting and built-in trading signals, everything in a nice, easy-to-use trading environment. Now, you can use their web trader, or you can download their MT4 trading platform for a more professional environment, or use both. You get live customer support, you get exceptional leverage, you get a wide range of analytic tools, you can partake in the Trading Academy and get use of all of their award-winning platforms. But one of the best features of Alvexo is their Trading Academy. You can learn, watch, and trade, plan, research, and manage your turnover, all free of charge. You have one-on-one classes, you have expert financial advice, you have a full library of ebooks and a broad range of videos to learn how to trade in the forex markets. Now, tonight's class is being recorded, and if you'd like to see a recorded version of this class, you can use the same link you used to come to tonight's class, or in a week or so, you can go to www.investing.com, where the class, where you signed up for the class, and you can go look for the education tab and locate webinars on demand. But it takes a week or so for them to get it all edited and up there for you. So the fastest way to use it, access it right away, is just to use the same link you used for tonight's class. Now, because Alvexo is a regulated provider, I need to give you a risk warning. So let me read that and get it out of the way. Trading forex, CFDs, and spread bets on margin carries a high level of risk and may not be suitable for all investors. You may lose more than your initial deposit and could be required to deposit additional funds. Please ensure you fully understand the risk and take care to manage your exposure. So let's get started talking about retracements and reversals. Now, it's very, very important that a trader is able to spot them and tell the difference. So the ability to point out the difference between a retracement and a potential reversal is a great tool to add to your trading arsenal. Many inexperienced traders, along with some of the most experienced traders, still are unable to detect the difference between an asset's retracement and a potential reversal. This is why today's webinar focus is to provide you with the information and knowledge needed to accurately determine whether an asset trend is forming a retracement or preparing for a reversal. So let's get started with some simple definitions. The question that most people ask is exactly what is a retracement? So retracements are actually momentary reversals that occur during a longer trend. Unlike reversals, retracements show a continuation of an opposing trend within a targeted asset's price action. So as you can see in the picture over here to the right, there are a couple retracements that take place and occur throughout a prolonged trading period. Now, one must understand a trend does not move like this. A trend moves in what we call pushes and eases. Push, ease, push, ease, push, ease. These eases can be called retracements because it takes a huge amount of effort to push an asset steadily upward. An asset doesn't just move upward. There's always a point where the buyers in the market, they're buying, selling the price up. At some given point, the buyers start to get sidelined because they start to say, okay, the price of this asset is too high. So I'm going to wait for it to ease back down, or I'm not sure I want to enter the market. So they just simply move to the side. That doesn't mean they're selling. they're taking a breather. Then also the ones who already bought into the market aren't adding onto their positions, or a lot of people who use good risk management trading and profit and reward trading have already set a take profit point. They're already saying, okay, I entered the market at this price. I'm going to close my position at that price. And they've set up a take profit point in their opening trade because they're completely happy taking 42 pips or 22 pips, whatever it is. And they've already set up a sell. So at some given point, as the price moves up, the new buyers move to the sidelines waiting to see if the price is going to continue moving up. The old buyers who entered the market already are selling off to book their profit. Not saying the asset's not going to rise anymore. A lot of traders, especially day traders, who are looking for just small position increases, are completely content and they've taken their profit. So what happens is the price eases down or it retraces. At some given point during this easement, the buyers are saying, okay, that price is low enough, I'm going to jump back in that market. Okay. So the buyers, these aren't the buyers who were in and sold out. These are the buyers who moved to the sidelines who were just saying a few minutes ago that the price was too high. They're moving back in the market. As they move back in the market, and as all of these sellers who sold or closed their positions are all cleaned out, the price then starts to move back up again. And as the price starts to move back up, more and more fresh buyers are jumping in the market and pushing price back up. And now this is a very simple explanation, but this is the crux of it all. Because remember, price is simply the meeting of minds between buyers and sellers. And the whole entire market is made up of the human element, human psychology. That's it. There is nothing else out there. So you may think, oh, this doesn't make sense, but it's really just when all the buyers around the world think that, okay, this is a good price, we're going to buy. So price starts moving up. And this is the way price should move. Because if it does, and you believe and you understand that this is the way trends move, you'll be comfortable and won't panic when price moves down. Okay. You'll say that's the normal course of a good, solid trend movement. And therefore, you'll stay in the market and you won't panic sell when the prices drop down to here and realize you could have ridden that market all the way out to here. Now, there's also a point in which this retracement starts to look like a reversal and you want to get out of the market. And that's the crux, is how do you know when that retracement or that small reversal that's actually retracement isn't a signal that that market is over and you need to get out? So then we have to understand what a reversal is. So reversals are temporary changes in an asset trend that occur over a short period of time. Oftentimes, these reversals can last for minutes, hours, or days. It just depends on what time frame you are utilizing your charting solution. Reversals are oftentimes drastic and do not represent a long continuation of an opposing trend during the asset's price action, like seen with retracements. So Wall Street is chock full of investment idioms, or perhaps none are so broadly quoted as cut your losses short and let your winners run on. Well, that's really easy to say because it's very, very hard to predict when an asset is retracing or reversing. So if an investor to know whether a stock is or an asset is merely retracing against an existing trend or if the trend has outright reversed. Successful investing is predicated on knowing the answer to that question. Now, the fact is there are some general rules, okay, to see the difference. it's very hard because they don't always fit. I, for one, firmly believe in looking at volume. Okay. Volume will help tell you, because again, if you believe that the market is made up of human beings and those human beings react, if you don't see those human beings supporting that move, so in other words, if you see price moving down and you don't see buyers or volume increasing and volume steadily decreasing, okay, you've got to wonder if that trend is going to turn around and reverse back up. If it turns around from a retracement, or it turns around from reversal and starts to move back up, if the buyers aren't jumping back in the market, then it's really just a little hitch in a reversal. So we want to look at volume. So we'll look at profit taking by retail traders. So if price moved up, price is moving up, and it begins to move back down, that's most likely, like I said, retail traders taking profit. They've marked in, I'm going to take my 42 pips and they're selling out now. Whereas a reversal is going to happen when institutional traders, hedge funds, JP Morgan Chase, all these guys are selling big blocks to get out of an asset. They've pushed it all up. They don't believe in it anymore. And when they start getting out of an asset, believe me, it's about to reverse. So money flow is important. When buying interest during the decline or very little buying interest, chart patterns very rarely will really tell you this. Candlesticks might help you see reversal signals, but usually not. Now, everybody has their own unique way of doing this. I firmly look at support and resistance levels and trend lines. Now, of course, we also want to take a look at fundamentals. Did something happen? Did something hit the headlines? Did economics data come out that disappointed? Did some geopolitical situation occur? Now, there are some candlesticks, like a lot of dojis, a lot of indecision candles might happen. Whereas for reversals, we might see engulfing candles or three black soldiers. But again, it's very hard to recognize these. But when you're faced with these situations, you only really have three options. There aren't many choices in the matter, and that's the important thing. Because since there isn't a rock bottom price, there is nothing to tell you it's a retracement or a reversal. You have to make some firm decisions. Okay, so you have these three decisions or three choices. And this is what makes the difference between you and the guy next to you. First, you can hold throughout the sell-off, which could result in large losses. The retracement turns out to be a larger trend reversal. And that's a problem. Because even as small guys, we hold it through that retracement and it gets a reversal, it might be too late or we end up getting on the market with losses. And that's something we don't want to do. Now, the second choice is you could sell and rebuy if the price recovers. Now, a lot of day traders, a lot of newbie traders, and even in fact some experienced traders will do exactly that. I do it often. Okay. And I'll sell and I'll just say, okay, you know what? I'm getting out of the market. As long as I could sell with profit, I'll just say, you know what? I'll take the profit and run. And I'll put a buy order for at a reversal point and enter the market. Now, the fact is we're paying double commission or double spreads. But if I'm making profit, I don't really care. But if I'm negating my loss, a potential loss, and I lose 10 points of profit because I sold, got out of the market, then re-entered the market if it bounced back at the level I thought it would, well, and these days, it's not a problem most of the time buying into the market. So if you set a limit order at a price, you'll get most likely in the market. But you're wasting money on spreads or commissions. That's about it. Or the third choice is just to sell, take your profit, and go on to a different asset. But these are three basic choices. You have to decide what the asset fits and what your personality fits. I mean, for me, number 2 works the best. Now, by properly identifying the movement as either a retracement or reversal, you can reduce costs, limit losses, and preserve gains. But the fact is, traders have an expression for attempting to pick a market top or market bottom, and they call it trying to catch a knife. So as the expression implies, it can be downright dangerous and is not normally recommended, but there are some ways to lower your risk. Now, if you're a good trader who has a solid trading plan and uses money management skills and risk and reward ratios, like me, basically, once I've entered a trade, I've set up everything I'm going to do with that trade on paper before I've entered the trade. Now, you can use trailing stop losses because as the asset moves in your favor, you keep moving that stop loss up closer. So what? I get, you know, if you're not the guy who's constantly whining, well, you know what? I could have made 100 points, but I only made 82. Well, I'm the guy who's happy. I made 82. I don't ever look at what I could have made. So I always use my stop losses, my take profit, and I've already got a take profit level set. So I'm one of those guys who's taking his profit before that forces that retracement to happen. But remember, retracements are healthy components of a trend. So the market in general can become tired of moving in the same direction. It takes a lot of work and money to send an asset to higher highs. When the price gets too high, buying pressure runs out and the money dries up. When demand dries up, price begins to fall and causes the chart to head south. This causes security to become more appealing to prospective buyers who believe the stock or the asset has the potential of moving higher. But we're waiting for better opportunities. As the prices become more appealing at lower points, the buyers step in, creating demand, and once again, the price begins another leg higher. So there are many methods that we can use to support our decisions on retracements. So support and resistance lines are key numbers to look at because they'll help you see whether the asset has reached a lower low or a low that is, or a support line that it should be bouncing off of. Combine them with Fibonacci's and pivot points. You have 3 solid price levels that if you see being broken, maybe you're saying this isn't a healthy retracement, we're moving into a reversal. So you can see that after a retracement, a healthy part of a trend, the asset was unable to push to higher highs. Instead, the security rolled over and created lower highs. A lower high is unhealthy, but it's not the end of a bullish trend. It's possible that after setting a lower high, the stock could retrace again, never setting a lower low and then push above the previous high to higher highs. The nail in the coffin for a bullish trend is established by the lower low. Once a lower low is in place, your trend is over. We can call it a reversal. Okay. Again, a retracement moved into a reversal. If you draw very good trend lines, simply breaking that trend line will give you a big clue that you've moved into a reversal. So let's set some guidelines. Reversals are defined as a change in the overall trend of a price. Now, reversal is not defined as a change in the trend line. It's a change in the overall trend because remember, trend lines can be broken and redrawn over and over again because sometimes a trend starts out with a high momentum and then starts to move into a normal momentum, especially when something pushes an asset up and you're constantly redrawing trend lines, but it's still an uptrend and still continuing upward. So a reversal is when an uptrend switches to a downtrend. That's a reversal. When a downtrend switches to an uptrend, it's a reversal also. And that reversal point is where they switch. Now, a lot of times they go into a lot of congestion. they move sideways, they move all around before they do. But there's usually always a point where you can define a reversal. So again, you're still faced with three scenarios. You have the three options we had before. When you start to see a retracement, when it becomes a potential reversal, you could close your position and re-enter if the price starts moving with the overall trend again. Or you could permanently close your position. But be prepared because reversals can happen at any time. So choosing the best option isn't always available. And also, a reversal can be very harsh. Just because an asset's moving up and looks like it's starting to retrace, that reversal, when it kicks in, can be straight down. So we want to combine several tools. And I keep referring to them, but everybody uses these, okay? You can develop your own, but Fibonacci retracements, pivot point support and resistance level, trend line support and resistance levels. Chart patterns will help you, like looking for triangles and waiting for a breakout of a triangle. So Fibonacci retracements are excellent tools for calculating the scope of retracement. They are most widely used in the forex market, but are also used in the stock market and all CFDs. To use them, simply use a Fibonacci retracement tool available in most charting software. So let's go over and real quickly look at a chart of gold. Okay, now today's chart on gold this is current gold in 1 hour chart. Now, if we were to look at this, do we have an uptrend and a healthy reversal? And one of the best, because we had a push and an ease, a push and ease. So the question is this a steep retracement or is this a price reversal? Well, at this point, it looks like it is a retracement. But how would we determine that? Well, the first thing is we could look at an asset in a wider time frame. Let me just get my marker off of here. And so if we were to go back and look at gold in a 4 hour time frame, okay, we're in this downtrend, push, ease, push. So we can see that this isn't currently a reversal. I mean, it doesn't currently look like it's a retracement or an ease from that 1 hour gold. It looks like we're in a downtrend here, a longer term downtrend. If we move it out a little bit farther, because we're looking to identify where we stand in this current price movement. So what we actually have then is we have a downtrend, push, ease, push, ease, push, and we're in the ease or a slight retracement of a very hardcore downtrend. Gold falling from 1365 as low as 1240. So if we were to know that this is actually a retracement of a downtrend, if we were to pop back here to the 1 hour chart, we'd have a better understanding of what we're looking at. So we're not looking at a retracement of an uptrend. We're looking at this whole movement as being a retracement of a downtrend. If we were to also drop on here at the same time, so that's just giving you a better understanding. If we were to go over here and drop on our Fibonacci retracement tool, we can see the price fell down exactly, look at that, to the 61.8 Fibonacci retracement, bounced off there, moved to 50, and it's now hanging at that critical 38.2. It's broken above and staying above. So we would look at price moving back up to that 23.6 level and back up to the 100% level. But we can see how these fib levels have really held on to it quite well. So that tells us that this could be a good, honest retracement of this short-term downtrend. And this what we would have seen is this is probably a point that buyers would have re-entered the market right here and look at the buying and the volume at this level. The price is volume as price moved back up. the volume has fallen tremendously, but it's also the markets are closing for the day. But we might want to look at this, okay, using some secondary tools. If we draw a longer term trend line on here, it really doesn't help us. I mean, it's gonna give us some help moving forward, but right now we don't even have, we have 2 points in common, but we don't even have anywhere near a third to give us a valid trend line. Now we can also take a look and see, using eyeballing, if we were to eyeball, so price is right here, and we were to look for some significant highs and lows, we might find there we have the next resistance level. Let's see if we can find a decent support level. The most historical support level we have here. Now we'd have to go back farther to find some more, and we could add on lots of other tools, but what we're trying to do is decide whether this is actually a reversal or a retracement. Now, me, I probably would have sold when it broke the 38.2 level, and I probably would have sold for sure when it hit the 50% level. But I would have been re-entering the market when it broke back above the 50% level, especially with this bullish candle right here. And I would have probably been back in the market. So I probably would have sold out somewhere at this 50% level and then re-entered back when it came back to that 50% level. But that would have been my strategy, not necessarily yours. So Fibonacci retracement tools are excellent tools for calculating the scope of retracement. They are most widely used in the forex market, but also used in stock markets. To use them, simply use the Fibonacci retracement tool available in most charting software to draw the line to the top and the bottom of the latest impulse wave. Okay. Now, if you don't understand fibs, because we've been talking about them generally, we do have a 1-hour class on Fibonacci retracements, and we'll show you how to use them and calculate them. But they work very well. So do pivot points. Now, pivot points come off of a pivot point calculator or from a pivot point chart. And we can use these by using like the calculator, and we drop them in, or we can go to investing.com and look under technical analysis, and we can pull up the current pivot points and put those on our trend line. Then we have trend line support. Finally, if major trend lines supporting the larger trend are broken on high volume, then a reversal is most likely in effect. Chart patterns and candlesticks are often used in conjunction with these trend lines to confirm reversals. Chart patterns have an established definition and criteria, but there are no patterns that tell you with 100% certainty where a security is headed. One of the most reliable chart patterns for a reversal is a head and shoulders pattern. When that right shoulder has formed and price starts moving back down to the neckline, you are most likely in a very strong reversal mode. The process of identifying chart patterns based on these criteria is subjective in nature, which is why charting is often seen as more of an art than science. So double tops and double bottoms don't tell you much. Triple tops and triple bottom don't really tell you much. They give you some indication. But one of the most reliable, as I said, is the head and shoulders patterns. Then we also have triangles. So two of the most popular chart patterns for reversals and continuations. A reversal pattern signals that a prior trend will reverse upon completion of the pattern, while continuation pattern signals that a trend will continue once the pattern is complete. These patterns can be found across any time frame. So we have ascending triangles, descending triangles, symmetrical triangles. And if you don't understand these chart patterns, we have an entire class dedicated to chart patterns, and we'll teach you about these. Now remember, technical analysis is the study of historical price performance in an effort to predict future price performance. Price is the only accurate measure of investor sentiment. That, combined with volume, will tell you a real story. It is the intersection of supply and demand. Investor sentiment is at least and possibly a more important determinant of price than fundamental factors like earning, revenue, inflation, bank rates. There are three important principles that govern technical analysis. First, price is not random. Second, price anticipates fundamental change. And third, the relationship between price and time is linear. Different strategies have varying degrees of success depending on where the market is in a bigger time frame. Technical analysis of a strong uptrending market will show that basing patterns are frequently broken to the upside, forming stair-step chart patterns. This is a strong chart pattern in a strong market. In other words, push and ease, stair steps. Push, ease, push, ease, push, ease, push, ease. And you'll find that these eases usually will be at 38%, 50%, or 62% of the original push. And that's what the basis of Fibonacci is. Now, triangles are a very common pattern, but when they develop, chartists look for some very important things. So we have symmetrical triangles, ascending triangles, and descending triangles. Triangles are very, very popular, but they occur very often. But if you use the understanding, I mean, there's lots of complexities to this, but if you just use the understanding as the apex of this triangle develops, the traders are being pushed into this point. At some point, those traders either have to break out. They can break up or they can break down, but they're going to break out of this pattern. And as it gets closer and closer to that apex, that pent-up demand forces that breakout. Now, symmetrical triangles occur when two trend lines converge towards each other and a signal only that a breakout is likely to occur, not the direction. Now, a symmetrical triangle strategy is one that is simple and effective enough to let you know that you gain from the momentum without staying a second longer than necessary. The strategy relies on patterns that, no surprise, are called symmetrical triangles. But when you see a symmetrical triangle developing and you have a breakout, either up or down, you can take a look at volume. If volume supports that breakout and it's in the direction of the trend, so a break up or break down, depending where the trend was, and that volume's increasing, that means most likely you're moving back into a retracement. If volume is either decreasing or steady, that means you're not supporting that breakout in that direction. Or if it breaks out in the opposite direction of the trend, then you're moving into a reversal. Now, remember, keep calm, don't panic and sell out of a market, and don't jump into a market, okay? Understanding the difference between a retracement and a reversal is easy on paper, but in real life, when you're actually trading it and the markets are moving, you can tend to panic and sell or buy too soon or too late. So the best thing is to learn to set up price levels ahead of time. Look at your price and your profit reward ratios. Look at where you put your stop loss. Decide at what level you're going to get out of the market if the market reverses or retraces. And decide which of those three strategies best fit your personality and just execute them. But remember, understanding that price does move in these stair-step patterns. Push and ease, push and ease. And the more you get to see this, the more you believe it. And you won't panic sell at these levels. Maybe panic sell at this level, but you don't want to panic sell in here. you want to understand is you'll be chasing the market forever. You need to understand that this is a normal movement of a trending market. So on that note, I'm going to say goodnight to everybody. Thank you very much for joining us, and thank you for supporting both Alvexo and investing.com. Have a good night now.